Hey guys, hope you had a great weekend. Starting off today looking at SPY. So over the past week or so, a lot of conversations I've had concern the imminent market crash. I've been reading on Reddit a lot of posts about the market possibly crashing. And I want to talk about why that's not likely to occur. And also, if it does occur, it won't be as bad as people think it will be, right? So look at the current chart on SPY, for example, right? 445, we've had a serious run over the last year. Last time we crashed was back in March of last year due to COVID, right? That big crash from high of 339 down to a low of 218 or so. So this crash occurred over the span of about a month, right? 35% drawdown in about a month. It took us about 4 months to recover from that crash, right? And anyone who bought the dip did very, very well over the last couple of years, right? So what is a crash, first of all? A crash would be defined as anything over 20% in the market. For us to have a crash right now on SPY, we'd have to fall roughly from the current price down to about 350 or so, right? That takes us back to the price we were at on November 5th of last year. So about, 3/4 of a year back. Not too far back, right? If you look at names like Apple, for example, or Microsoft, and see where they were if you pull back 20%. Like Apple, for example, was at all-time highs last week, pulled back heavily on Friday due to news that Epic Games won the lawsuit decision, right? And look at where we'd be on Apple, right? 20% pullback takes us to about 125-ish, which we were at back in June, right? So only a few months ago. So these pullbacks or crashes, as people call them, aren't going to be as bad as people think, right? For one. Secondly, you're not going to see a massive market crash in the manner of 50 to 70% or 80%, kind of like the 1920s, for the simple reason that the world right now relies so heavily on the stock market, right? Think about what the market is. The market is essentially the nervous system of the global economy, right? Without higher stock prices, companies can't issue shares to make acquisitions, to acquire new talent, right? Huge issue, obviously, if the market were to crash. Pension funds can blow up. That means that people don't have money to spend. This creates a much, much larger calamity globally than just, you or I losing a few bucks in the market. So the fear mongering that people are putting forth that the market crash is imminent, and we're going to see, a huge drawdown of like 50%, very misplaced. Also remember that the game has changed. So over the last 20, 30 years, monetary policy has changed to an MMT policy instead. And with that printing of tons of money, we have inflation in unconventional assets, right? What happens in inflation? Well, the price of everything goes up. Cars go up, trucks go up, factories go up, buildings go up. You see inflation everywhere. What does that mean for corporations? Corporations own assets. That means they also inflate in value as well, right? I mentioned last year in one of my talks that we might see inflation in the market, and sure enough, we're seeing extreme inflation in the market as well, right? So being fearful about a crash, I'm sure if you're worried about your money in the short term, yes, that's a valid concern. But realistically speaking, to be concerned about a crash of more than like 20% is not really logical, given that we can see going out even 10 years, for example, right? How many large dips have we had over the last 10 years, right? We had a nice pullback in 2018, October. That was a pullback of about what? From peak to valley, 34% or so, right? Recovery occurred by the following year. So a year later, you were up again. And then obviously the COVID crash, which I mentioned already, took about a month to crash, followed by about 4 months to recover that. Now we are up from that point, previous all-time high, to the current point. We're up about, what is that? Oh, this is Apple, sorry. I meant to be looking at SPY. Either way, for argument's sake, with Apple, we're up 90% from the previous all-time high before the COVID crash, right? So just think about that, like almost 100%. Even if you had held through, even if you bought the previous all-time high, held through the crash till now, about a year and a half later, you're up almost 100%, right? So again, you want to stay longer term in solid assets. Owning crappy assets like GameStop and AMC and these meme stocks isn't a great way to increase your wealth. Sure, in the short term, you can catch a trade here and there, but it's not a reproducible or repeatable way to make money in the market, right? Buying solid assets and holding them long term is a way to make money in the long term as well, right? And I mentioned last week, if you want to hedge yourself, use a smart strategy, kind of like a ratio spread, for example. If you can't do ratio spreads, if you don't have enough margin in your account, which some people don't, using a put spread out of the money can be a decent means to doing that as well. Same idea. So again, being concerned about a market crash occurring, any week or any month now, could we pull back 10%? Absolutely, for sure. Would you be buying the dip on that? Yes, because there's so much cash globally right now, and there's such a hunger for yield. Where else are you going to get yield in this yield-starved world where bonds are offering nothing essentially, fixed income is crap, and you have rapid inflation? Well, you got to go in the market or in real estate. Unfortunately, real estate's inflated so much that a lot of people can't afford to buy real estate. So the market is where you want to park your cash. But again, in solid assets. The FANG man names have done very well. Facebook, Amazon, Apple, Netflix, Google, NVIDIA, Microsoft, AMD, right? They've done very, very well over the last few years. And why? Because the revenues are expanding. Profitability is very, very strong. Balance sheets are solid as well. And they're seeing inflation in their assets as well, right? So staying long bias makes a lot of sense. Keep cash on the side, obviously, and be efficient with your capital. And again, using options is a great way to be efficient with your capital. So for example, let's say you wanted to have a portfolio, you have a portfolio of 100 grand, right? And you have money in a few different assets. Let's say you have money in Apple, for example, right? So if you have 100 shares right now in Apple, you have about 15 grand there. How could you replicate Apple's position using options, using a fraction of the amount of cash, right? To keep your asymmetry risk favorable, also to maintain a larger cash position if you wanted to. Well, looking at the option chain, if you were to go out, for example, a year out.
You're on the charts.
Yeah, I'm changing right now. Yeah. A year out right now to January 2023. That's more than a year, actually. For example, if you're to go out to the 100 strike on Apple, you're paying $53 per contract. Your break even is $153. Current price is $149 roughly. On Friday, we were at $155 before the pullback. Essentially, you're spending $5,300 for almost the same position as it would cost you to own 100 shares, right? So to buy 100 shares, it costs you about 15 grand. Whereas to buy one in the money Leaps contract, call option at the 100 strike deep in the money, your break even is roughly the current price of the stock, meaning that you're paying 1/3 the cost to own the same position in Apple stock instead of buying 100 shares, right? So this is what I mean by capital efficiency, right? Again, if you don't understand what I'm talking about, do some more homework because it's very important that you're capitally efficient in your portfolio if you want to manage your risk well. So think about that. You can have 10K in cash and 5 grand in Apple using a Leaps contract, right, for a year and a half out. And you have the exact same exposure to the upside, but a fraction of the downside. You have 1/3 the downside in Apple as well. Also factor in too that if the market were to crash, so to speak, 20% or more, the IV would spike so much that your call options would not decline as much as you think they would. Because right now, let's say, for example, Apple fell down to $100 a share. So you went right to at the money. What would happen to this option right now? Well, how much right now is a 150 strike call option to the same expiration date? That call option is $20 right now. This means that if Apple were to fall from 148 right now, the current price, to $100, your call option would be worth approximately $20, which means you would lose $30 of value on the option, whereas in the stock, you would lose $48 of value. So see how this can be beneficial for you if you're managing your risk correctly, right? Again, if you don't understand what I'm talking about, do some more homework. It's very important that you do if you want to manage your risk well. Combine this strategy where you're buying, for example, a call option on Apple, a call option on Microsoft, a call option on Facebook or NVIDIA or AMD or DuPont or whatever companies you believe in, right? You can have a nice portfolio of Leaps contracts. Make sure liquidity is high, obviously. So you want to have higher open interest and decent volume as well. And then if you want to hedge it, for example, with some put ratio spreads or some put spreads in the shorter term or midterm, if you're concerned about a pullback, you can do that as well, right? Last week, I outlined a strategy where essentially if NASDAQ were to fall about 10%, you can make a crazy return on a position that would have a payoff of $50 if the market were to stay idle or go up at all, or even drop a little bit, right? So outlining the different scenarios is very important in looking at what could possibly happen in the market, right? What is the probability on a monthly basis of a market crashing 20%? Not very high. So timing the market on a decline, of 20% over a short period of time is very difficult. As I mentioned last week as well, buying put options on SPY or QQQ or IWM is very expensive due to the nature of put options out of the money, which cause them to be roughly double the price of equivalently priced out of the money call options. So for example, current price on SPY 445. So right here at the money, same price for 8 days out. Let's go out to January, for example, right? So at the money 445 again. So the call options are $18, put options $19, a little bit more expensive. Let's go out of the money $15. So upside 460, downside 430. The call options at 460 cost how much? $9.50. The put options at 430 cost how much? Almost $15. There's a 50% premium placed on the put options because they're used as insurance, right? And also because, as I mentioned last week, the markets tend to fall much faster than they rise. But also, when the markets fall fast, they also recover fast as well, right? So again, being concerned about the market falling and preventing yourself from being long biased and names that have good value is a mistake as inflation creeps up higher and higher and higher, because these assets will keep increasing due to inflation. And also keeping your money in cash, large hoards of cash, doesn't make a lot of sense unless, of course, you're using a synthetic position using leaps, right? In which case you have upside exposure using a fraction of the amount of money you would use to buy the stock, right? Having that additional cash on the sidelines doesn't mean you leverage yourself and buy 3 contracts in Apple for 15 grand. No. You still buy 1 contract. You have 10K on the sidelines. If the market pulls back and Apple goes down to $100, you can buy a second contract or a third contract for $20 each, lowering your average price. What happens when the market recovers? You make money, right? So, I want to discuss that primarily because obviously each week there's a different theme in the market. And of late, a lot of people are talking about a crash and how to hedge and how to, reposition themselves. Honestly, by doing less, you tend to get more out of the market, right? So if you, leave your positions as is, assuming they're solid positions, and I don't mean like buying meme names or SPACs and buying options when the IV is super high. You want to be buying solid names at good valuations, buying in the money, buying some time on your options as well, right? Shorter term, you're going to have more gambling, right? So the shorter the duration of the contract, the more binary the outcome. Either you're going to win big or you're going to lose everything, essentially, right? So if you're buying a week out or 2 weeks out, it's pretty binary. When you're buying a year out, even if the stock craters all of a sudden in the next couple of days, you're not going to see a massive loss in that position. You might see, a drawdown 20%, but not 100% overnight, right? So very important to think about these things and not get too emotional, not get too caught up in what's happening in your portfolio and thinking the market's crashing because, you're holding some asset that's, not going up right now, or you're buying, call options or put options when premiums are expensive before an earning event. And obviously, all of a sudden the event passes by and the premiums get cut in half. Kind of like happened with GameStop. I think it was last week where people were buying options out of the money or at the money. And, it fell a little bit and everyone's like, hey, why, I bought put options. Why didn't I make money on this? Well, because the ID crushed, right? So just some food for thought there. This week, I'm not looking at too much overall for buying. I'm waiting on a few names to fall a bit further. The primary one I'm looking at right now is AMD, as I mentioned to a few guys in chat. So AMD had fallen last week for 4 days straight. Here's the chart. I'll pull it up right now so you guys can see it. AMD's chart. Here is the 1-year chart as well. If you notice, over the last roughly 10 days, we've fallen 9 out of the last 10 days. Last week, we fell from previous Friday close of 109.92. This Friday, 105. So about $5 decline in the past 4 days, which is last week. Now look for a bounce point somewhere around the 102 area, which was a previous low from August 19th, right? If you notice from the previous last year trend, after the gap up I'll pull it out 2 years actually, so you can see. After the gap up we had from the previous all-time high of around 60 to a new all-time high of 95, we sat in a range between 95 and 75 for pretty much a whole year. We broke up again recently back in August, sorry, July, August, right? And now look for support at the previous all-time high area. So just below 100 perhaps. I think 102 is going to hold pretty well. Again, you want to buy some time, and also look at NVIDIA, for example, as a template as what AMD can do. Once the XLNX merger goes through with AMD, a lot more certainty will occur in the stock. You'll see the price appreciate, I think, much more rapidly as well. But obviously manage your risk well, understand what you're doing, only risk we can afford to lose, and do your homework before you make any decisions, right? Don't make decisions based on emotion. And remember that you're gonna make more money holding your winners longer term and cutting your losses early versus, trying to swing trade day in, day out. The less seasoned you are in the markets, the more long-term bias you should be, right? That means that less experience you have trading or investing in the markets, the more focus you should be on longer term time frames, right? As you gain more experience, you can understand these more micro moves, right? Day to day, week to week. That allows you to trade and swing trade in and out of positions, profitably most of the time, right? But if you're new to the market and you're trading in and out of positions every single day, for one, you're going to miss the big moves, right? You might trade AMD in between, 75 and 85, make $5-10 per share, but you miss the move to, for example, 122, right? When it breaks out. That's what I mean. So I'm going to keep it short here, guys. A bit tired this week, and we're doing some Q&A. But if you have any questions or comments, drop them below, and I will address them as soon as I can. Manage your risk well, guys, and have a great week.